Hello, welcome all. Welcome back again to the NFO series that we regularly conduct with all of you guys, where we interact and have an insightful conversation with the top hierarchy, top management of AMCs to understand what the new fund offer is all about, why is it good, what this new fund offers to the investors, and how it is beneficial for their investment journey. And today we have Manish R from the ICICI Pru AMC. Manish R joined ICICI Pru AMC back in 2011 and has over 10 plus, 15 plus, I would say, 15 plus years of experience in the industry. He works as the head of product communication with the company, and he acts as a crucial link between the fund management team and the sales team. Welcome, sir. Welcome to this discussion. Very happy to have you here, and very excited to know more about this fund that is we are going to discuss.
Thank you. Thank you, AssetPlus, for giving us an opportunity to come and present it. Thank you.
Thank you so much, sir. This fund, that is ICICI Prudential Equity Minimum Variance Fund, that is a new fund that is going to come up. The NFO start date is today, that is 18th of November 2024, and the NFO period is open till December 2nd, 2024. Sir, my very first question is, what is this fund? I mean, let's start with the basics of what is this minimum variance fund?
Sure. I think first thing I would take few minutes to explain what do you mean by variance. What is variance all about, right? Because that's on that strategy is this fund completely constructed on. Now, variance means is, so I'll give you a very real life example and think of it as a real life example that if you want to go from your house to, let's say, airport, and normally on an average, it takes 1 hour.
Yeah.
Let's say, assume that.
Yeah.
And let's say if you are going to airport in a peak hour times, let's say when you have office timing and all that, then it will take maybe 1.5 hours.
Yeah.
Right. And let's say in a different situation, if you have to start from your house to airport, and that's a day when, let's say it's a Sunday, when hardly there is a traffic, you might take 45 minutes. Right. So the example which I've just quoted here is that on an average, it takes 1 hour, but based on the conditions, the variations is different. Like, so from average, it is taking on a peak hour, it's taking 30 minutes more. On a day like Sunday, the variation is 15 minutes lesser. So variance is all about how much a particular stock or an asset class is showing a variation compared to its long-term average. That's what is variance. In other words, we also say it volatility. So stock price being volatility, having higher volatility, or an asset class having higher volatilities. Basically, the factor is variance. So the first thing which I wanted to explain here, which I've kind of tried explaining, is this fund would be based on low volatility as a factor, right? So what we are going to do here is an equity minimum variance fund is simple. It's going to look at only Nifty 50 companies, large cap companies. On that Nifty 50 companies, we are going to use each and every stock. So 50 stocks which are there in Nifty 50, we are going to look at each and every stock. And we are going to look at what is the volatility of that stocks over a long period of time. And based on that, we are going to identify only those stocks in that space which are having low volatility. That's what this fund is going to do. And finally, when the stocks are selected, the fund manager will actively allocate weightages to these stocks which are finally selected. So in brief, this is what the NFO Prudential Equity Minimum Variance Fund is going to do.
Correct. Yes. So the next question is, I think is just an extension of what you actually said, that is the variance approach. So how does this minimum variance strategy help mitigate the portfolio volatility during the extreme market movements? I think we have seen quite a lot of market downturn in the last few weeks. I think that this question makes a lot of sense to the viewers. How does this fund is going to look at such conditions?
Sure. With your permission, if I can just put the presentation up.
Yes, sir, definitely, please.
So I think this is a slide which I'm referring to, and here, if you look at, just to give you a perspective, that this is a data from 2005 and
Correct.
almost till date. So roughly, you can say almost a 20-year or 19-20 years data. Here we have used various indices. So we have used one index, which is Nifty 100 low vol 30 TRI, just to
Correct.
give you an understanding how low volatile stocks, just to broadly give you a perspective how a low volatility stocks behave in a different market. So that's why we use this proxy of index as it is. Mid cap, we have used mid cap index as a proxy for mid cap schemes, stocks. Small cap, we have used small cap index for small cap stocks as a proxy, and then large cap 150. Now, in
Correct.
this whole long period, if you look at, low volatility as a strategy has given the best compounding in the last 19-20 years with the index
Yes.
18.4.
Yes.
Now,
Yes.
when you deep dive, and that's where the answer for your question lies, is that if you look at this whole history of last almost 19-20 years, I have split it into calendar year wise returns, right?
Yes.
I'll just give you an example here. If you focus on 2008
Yeah.
line here, and various indices we have put, which I've just mentioned. If you look at
Mm-hmm.
mid and small cap, corrected by almost 68-70%. Mid and small cap,
Yeah.
look at
Correct.
68 and 64%.
Yeah.
But if you look at the low volatility based index, it collapsed or fell only by 40%, right? So
Yeah.
it fell. I'm not saying it didn't fail, it fell, but the outperformance was almost 30%. So it protected a downside almost 30%. I can give you one more example just to clarify the point. Look at 2018 when
Yeah.
NBFC crisis happened, when small cap
Yeah.
corrected. You
Yeah.
can see small cap corrected by almost 26%, mid cap by 12%. In fact, this fund went up by 7%. So that's a very massive outperformance which it has given
Compared to,
compared
yeah.
to small cap. This is how it behaves in a downturn. Just to give you a broad perspective, that normally this is a large cap oriented fund. Uh, Plus it focuses on those funds which tends to be less volatile in various market conditions, so it invest in those stocks, and that's why the downside for this fund is much better compared to most of the market at different point of time. That's how we look at this.
Okay. So the next question then that comes to my mind is, can you elaborate rather on the what is the stock selection criteria? I mean, yes, then within the Nifty 50 universe for this fund, that is, I would like to know.
Sure. I'll just go. Yes.
Yeah.
So this is how the stock selection or the portfolio creation will happen for ICICI
Correct.
Equity Minimum Variance Fund. Is, like I said, we would be starting with Nifty 50 universe,
Mm-hmm.
the large cap stocks, the 50
Mm-hmm.
companies in that.
Mm-hmm.
And on those Nifty 50 companies, we are going to use low volatility as the filter. Uh,
Mm-hmm.
and we will individually study each and every stocks, that 50 stocks, and look for those stocks which are very high on volatility. We will take them out, and let's say the 33 stocks which we will get where there is low volatility is will which will pass through the filter,
Mm-hmm.
that will move to the next criteria of selecting the fund stocks basis the fundamental selection.
Mm-hmm.
What do you mean by fundamental selection? Is that that you look at each and every company's outlook, you will look at
Mm-hmm.
each and every company's earnings trajectory in the coming quarters. You will look at how management, how ambitious is management, what is the management execution, etc. All that fundamental attributes also we will consider,
Mm-hmm.
and based on the both the filter, that is your low volatility filter and the fundamental selection, the fund manager will actively manage the
Correct.
stock selection. So
Correct.
assume if there are stock A and stock B, both have same volatility factor, but
Mm-hmm.
one company, its future outlook or projections or earnings growth is much positive, then the fund
Mm-hmm.
manager has the flexibility to
Yeah.
increase or give higher weightage to that particular stock.
Correct.
That's what
Yes.
active management briefly means. And then finally we will create a portfolio of, let's say, roughly in the range of 30-35 stocks
Okay.
which would be low on volatility. So this is how the whole process is going to be there.
So then the next question is like, how does the fund ensure sectoral diversification while maintaining the low variance mandate?
Yeah. So actually for this, I think one of the myth buster which we have kept in our presentation and kind of trying to capture that is low volatility as a strategy does not mean only certain defensive sectors. Like whenever we talk about low volatility, people will think of, let's say, FMCG, pharma, IT, which does not move much.
Yeah.
People have a myth that it would be only biased towards those sectors. The answer is no. It is going to be a very well diversified approach, because when we talk about low volatility, it can be any sector which are going through a consolidation or which has been going through a very stable phase. Like for example, in the last 2-3 years, if you look at banking as a sector or finance as a sector has not moved much. So finance will get added into it. For the last 1.5 years, cement has not moved much. So finance may get it. So I'm saying it is a very well diversified strategy. And although this is a data heavy slide, but I'll just tell you, look at December 2023, just to give you an example.
Yeah.
You can see how diversified various sectors or how diversified this portfolio can be based on the low volatility strategy. This kind of a back-tested data which we have done on Nifty 50 stocks and Nifty 50 stocks based on the low volatility, that can be the sector allocation at a particular point of time. So if you look at 2023, we have almost 20-21% in finance, 6.5% in energy, 8% in FMCG, auto 10, cement 6, so on and so forth.
Okay.
This can be a very well diversified strategy also, because it focuses on low volatility as a thing. So any sector can qualify for that. Thank you.
Okay. And so then, how does the fund benefit from active allocation beyond the rule-based variance filtering?
Yes. So I'll just give you an example. Like what we does in active allocation is that one thing which I've told you very clearly, that here the fund manager has the flexibility to allocate certain weightages to stocks. So even if there are two stocks which are same on volatility, if the fund manager outlook is much positive, he can have higher weightage to that particular stock, right? So one is that. Second, the fund manager can also take a very top-down kind of approach. What I mean by top-down approach is that he can look at the overall Indian economy and understand that whether there is a high growth, whether there is more moderate growth, or whether there is low growth. So based on that, he can take some sectoral preference also. So suppose if it's a low growth kind of an environment, he can go for sector like FMCG, pharma, IT. Suppose if he feel that it is a high growth kind of an environment, he can go for infrastructure, real estate, etc., etc. Right. So there is going to be a top-down approach also in this fund, where fund manager will look at the macros or look at the economy, understand the growth trajectory, and based on that, he can have certain overweights towards some of the sectors where he can play out. So there is sector active allocation which he can do, stock active allocation which he can do, and then finally he can also construct portfolios based on let's say having stocks which are inversely correlated. I'll give you one example. Let's say if there is a situation that if there is not very clear trajectory which can be predicted for oil, it can go higher, it can go lower. In situation like this, what the fund manager can do to reduce the overall variance or volatility of the portfolio, what he can do is that he can take two stocks which are inversely correlated. I can give an example. Think of a paint manufacturing company. If oil prices goes up, the paint manufacturing companies gets negatively hit, because the input material for creating paints is oil. And in the meantime, we can also take a oil exploration company which explore or extract oil. If the oil prices goes up, they are positively impacted. So in such an uncertain kind of a situation, we can take those negatively correlated stocks. Fund manager knowing the broader picture, macro picture, understanding the. So there is an active thing also which he can do through taking these correlations. So that would be the active part which the fund manager will bring. Apart from that, 80% can be there for this strategy. The portfolio can be invested 80% in the low volatile stock. 20% there is flexibility to go outside of that also. So that would also be used by the fund manager to actively manage this one. Thank you.
I think so. You did, you kind of pre-answered my next question, which was the macroeconomic indicators such as
Yes.
crude oil prices and inflation. I think that's pretty much gave an
Covered in
understanding
this.
that, yes, understanding of how active allocation plays a role in this fund. Then the next question I would like to go is, who is the ideal investor for this fund? Like considering its focus on lower volatility and large cap exposure.
Sure. I think we've just put up a slide on this. Fortunately, whatever questions you have asked, we had a slide present, so that's why I'm just putting it across. I think one thing which people should understand is that, see, it's a very pure large cap strategy. Invest in those companies which are low in volatility in terms of stock price. So good strategy. But I just want to highlight that this is not a hybrid scheme. Many of the investors have asked us, or many of the partners have asked us, is it similar to, does it has a downside protection like hybrid? No, the answer is it's not similar to a hybrid scheme, because this is a fully diversified equity schemes. But the equity strategy which we are using is, you can say, a much defensive in the equity space, much defensive, because it's a large cap, low volatility kind of a
Yeah,
strategy.
yeah,
So that should be very clear with investors, that this is ideal for those investors who are looking for an equity allocation
correct.
with a very better risk adjusted kind of a returns by
Okay.
having stocks which are low volatile, pure large cap. That's
Correct.
what should be the endeavor. So investors looking for that kind of an approach should be investing in this fund.
Okay.
Thank you.
I think that's pretty much about it, sir. I think thank you so much for giving us your insights, and thank you so much, and hope to speak to you soon, sir.
Thank you. Thank you. All have a great day.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.